Consolidated, these are some of the standards that is involved in our consolidated financial statement. When we own share in another company, this is us. We own share in another company. So if standards involved is if you own equity share, it will be your financial instrument standard, remember? So what are they? IAS 32, IAS 39, IFRS 7, and IFRS 9. Okay, not 4 standards. So if you invest in share, in Maxis, if the share price from 1,000, of course, in total the value of the investment increased to 1,002. What is the treatment? From 1,000 increased to 1,002, investment price went up, investment go up by 200. Gain 200. So where will this 200 go to? P&L or OCI? P&L or OCI? So OCI 200. So OCI 200, P&L 200. Okay, if it's P&L, it can be number of financial assets. It can be debt. It can be equity. So this is equity investment in share in this company. Equity investment, it can be fair value through profit and loss. It can be fair value through OCI. So this time you say P&L or OCI, both can. But what's the condition for OCI? You want to measure the changes in your OCI, you must make an irrevocable election on initial recognition to measure the changes in the OCI. Irrevocable election, and it is held for long term to earn dividend, then OCI. Otherwise, it will be P&L. Yes. You must make an irrevocable election. Okay? However, if you own more than 20%, 30%, 40%, 50%, 60%, so some will be significant influence, correct? Associates. If it's subsidiary, what's the keyword? Subsidiary. Control. Okay, right? So when you have significant influence, it will be under associate. Significant influence. Okay? If you own more than 50%, whereby you have a control over the company, then it will be subsidiary, consolidated financial statement, together with IFRS 3, business combination. Okay, so after that, you're going to learn joint venture. So we forget about MFRS disclosure. Okay. So owning share at different percentage, different ownership, shareholdings would have we apply different standards. Okay? Okay. Goodwill, page 4. Remember this format? To calculate your goodwill, this will be a format. I'll show it here. Goodwill calculation. Consideration transfer. Cash. What else? Besides paying cash to acquire, let's say 80%. Share exchange. What else? I pay cash. I issue share to acquire the share. I issue my share to acquire the share. No? Deferred consideration. Contingent consideration. What else? I issue a loan note to acquire their share. Possible. Okay. So you debit your investment here, debit your investment, debit. So you debit everything. So you're going to credit your cash because you pay. You're going to credit your share because you're going to issue share. Credit your deferred consideration, your liability, because you're going to pay in the future. Credit contingent consideration and credit your loan. Debit the whole thing, goodwill calculation, and credit here in the you pay, you credit your equity share because you issue your share, credit your consideration because you owe money, contingent you owe money, and loan, you issue a loan, loan note to buy. So you actually owe the money. Okay? So when you debit, this you record here, altogether you purchase 80%. Then fair value of non-controlling interest, this will be the 20%, right? Total up. Less that's what. Fair value of net asset acquired at date of acquisition. Fair value of net assets at date of acquisition. When you buy, the fair value of the net asset that you acquire. So example will be equity share or your ordinary share. Your ordinary share, when ordinary share is equity share. What else did you acquire? Share premium, right? Revaluation reserves, pre-acquisition profit, or your pre-acquisition profit. Any more? Any more? Contingent liability of subsidiary. Contingent liability, because when I took over the subsidy has got a contingent liability. So I use it to reduce the fair value of the net assets. Liability we reduce. Okay? What else? If you got any intangible asset, include fair value adjustment include. So total, okay, I give a value here. If let's say this is 2000, okay, add up 2000, this one add up is 1007. So we have a book yield of 300. So this 300 here compared to impairment of goodwill. Is it okay? Okay. So have I explained before this one? Deferred consideration? Yes, right? Still remember? Deferred? No. Yes. Never mind, one more time. Quick one. Deferred consideration, you see, this is year 0, year 1 lah. I pay cash of 1000. Share exchange today, the value is 2000. And then I decide or I agree to pay a deferred consideration in year 1. Means when I buy the company share 80%, I agree to pay cash today, share exchange today, and I agree to pay 1 in 1 year time. So what must I do with this 1001? If the discount rate is 10%, I'm going to discount this by 10% in 1 year. So when I discount it, it will become 1000. So the consideration I use here will be 1000 today's price. So what do I do with this 1000? This 1000, end of the year, I need to unwind. Okay, unwind how many percent? 10%, that will be 100. So what do I do with this 100? Yeah, I debit finance cost and I credit deferred consideration of 100. So deferred consideration 100, 1000 plus 100, 1001 is a liability. So by tomorrow, let's say 1st January the next year, I'm going to pay 1100. It's a liability. Today I recognize 1000. 1 year later I unwind 100. So the total I owe to my shareholder is 1001. So I agree to pay 1001 in 1 year time. Okay, so it's a liability. So when you console, you're going to have expenses, finance cost 100, and you're going to have a liability of 1001. Okay? Contingent consideration is different from deferred consideration because deferred consideration I must pay. I agree to pay 1 means I'm going to pay 1 next year. Deferred consideration depends. Depends on the event, the occurrence of certain event or non-occurrence of certain event. You make a profit of this much, if the subsidiary make a profit of 5 million, I'm going to pay you another 1 million. If you make less than that, I'm going to pay you 300,000. So it depends on certain event. Clear? Contingent. Okay? Loan note, I agree to pay you, but I do not pay you cash. I'm going to issue you a loan note, means I owe you money, and I'm going to pay 10%, 10% every year. This loan note can carry about 5 years period, possible? Yes. I take over your share, I owe you money for 5 years. Interest is 10%. Okay? So your exam focus more on, of course, cash is important. Share exchange, yes, last time, but it's quite important, right? Your CR1 or your FR2. deferred consideration, yeah, will be tested. Okay, contingent consideration, yeah, some question we have. 10% don't know, you just have to know. Don't need to worry about it. Yeah. But just to let you know, there's something called 10% don't know. You don't know that. Alright. Now, focus on this one here. 2000 and we left the fair value. Fair value. We learned in our chapter 13, fair value of assets. We have to apply fair value of the assets acquired at the date of acquisition. And the fair value of the subsidiary is 1007. So I pay 2000, my 80% plus subsidiary plus NCM 30%, our 100%. We acquire fair value of the subsidiary at 1007. So that's why we are paying goodwill. We are paying extra 300 for your exam and higher number. Normally 1007 will be given. Our question 1007 will be given. Meaning the 2000 you have to find yourself. 1007 will be given. So you can straight away find the goodwill. Then, if it's 1007 is given, the net asset is given. What you are asked to find is fair value adjustment. This will be given 1007, and this one you can get it from the question. Let's say it is your share capital is 300, share premium is 100, revaluation is 100. Pre-acquisition will also be given normally, and this is 200. Contingent liability probably is 100 bracket because it's a liability. So what is it? I take over subsidiary, and in the subsidiary they have a disclosure. You know, contingent liability is a disclosure. It's not a liability; it's a disclosure. So when I took over subsidiary, a disclosure in my subsidiary, I'll record them as my liability. Now, who be calculated? Repeat, IS 37, provision, contingent asset, contingent liability. Provision is a liability, already recognized. Contingent liability, not recognized, disclosure. However, when we took over, when they have this disclosure of 100, we will take it as our liability. Good. So, a liability we have to minus. Intangible asset, example, they have a customer base, customer name list, customer base, or because they are developing some assets which they haven't recognized. But when we took over, its value is about 100. So we must also recognize it in our book. Intangible asset, subsidiary, they do not recognize IS 38 unless it meets the 6 criteria. Pirate, if you meet the 6, they will recognize. However, during business combination, we're going to recognize them as fair value. And lastly, how much is it in total? 1002. 1002. But my net asset is 1007. So what's the missing figure? Fair value adjustment 500. I know my fair value net asset is 1007. The rest all are given or can be found. So they tell you the difference here is due to a fair value adjustment to the asset. So the fair value will be 500. Okay, so you have to look at the question carefully. Sometimes it's the fair value on a piece of land in which we do not have to depreciate. It can be building in which we have to depreciate. Land no need to depreciate, building we need. So the question will tell you the fair value adjustment can be a piece of land or a property subject to depreciation. Normally it's two. Okay. Why? Okay, so In the first part here, we can see contingent consideration already explained. So this consideration will be paid or will be received in the future on the event or on the occurrence of certain event or not occurrence of certain event. Done. Pro forma, done. Fair value of net asset acquired, ordinary share premium, this is pre-acquisition. Done. Now we look at the NCI. There are two methods to value NCI. One is at fair value, one is proportionate. I'll take it proportionate as method number one. Fair value will be number two. You learned this before? Yes? Yes. Forgot. Remember? Forgot. Any? Forgot. Yes, remember. Yes, Alex remember. So move on. Okay. Now we go to the key line. Important. So goodwill calculation in proportion of the net asset, method one, proportionate. In proportion of the net asset, proportionate, method one. We have method two, whereby NCI will be at fair value, method two. So, example, on 31st December, Penn acquired 4 out of 5. How many percent? Yeah, I acquired 80% of ordinary share of the subsidy of $1 each of S. P Penn is parent, Sylvania S subsidiary. S subsidiary. And I pay 10 million. On this date, the fair value on net asset was 7.5. Given. Which one is given? This one. The fair value on net asset is given. And I pay how much? Cash 10. It is group policy to value the NCI. How many percent is the NCI? 20%. The value of the NCI at its proportionate share. Method number one. Of fair value of the subsidiaries identifiable assets. So goodwill calculation or acquisition will be like this. I acquire 80%, and the 80% is 10 million. This one 1,005 later, do not know yet. Cannot, so you can put in there 10, or I show you step by step. Like this. Consideration transferred will be 10. This is our 80%. And you know we have to record the NCI and 10%. So we do not know yet. So less what? Less the fair value of net asset acquired. Okay. So normally we have ordinary share capital, we have retained earning. Whatever the amount you add up, and it's given here as 7,005 net asset. Clear? Given. I own how many percent of the 7,500? This is the parent, this is a subsidy, and their net asset is means asset minus liability 7,500. I'm acquiring 80%. Means 20% don't belong to me. So 20% of 7,500 is how much? 20% of 7,500. It will be 1,500. Clear? So your total up is 11,500. You minus the total here. This will be the 4,000. This is how you do it. Okay, the 1,005, you get it from here. Okay. So now the value of my NCI, 20%. You take this and you times with 20% is 1,005. So is it at their proportion? They own 20%. So NCI will be valued at 20% of their net asset. So it's based on their proportion portion of 20%. Better one. Next question is this goodwill belongs to who? Parent or NCI or both? Parent only, parent and NCI. I give you two scenarios. It's parent only. This goodwill belongs only to parent. I'll show you later. Prove it to you. Belongs only to parent. Okay. B. The NCI will be valued at fair value, which is method 2. NCI not at proportionate, but is at fair value. On 31st, acquire 4 out of 5, 80%. Pay 10 million, same. On that date, the fair value of souvenirs is 7.5. It's group policy to value NCI at fair value, method 2. The market price of the share held by NCI just before the acquisition was $2 a share, $2 per share. How many shares they own? This is a company, subsidiary. They have 5 million shares, correct? Of which 20% belongs to NCI. So NCI owns 1 million shares. And 1 share is $2. So the fair value of NCI is 2 million. Okay, no? $5 million shares. NCI owns 20%, means NCI owns 1 million shares. And each share is worth $2. So the value of the 20% is 2 million. This is the fair value. Because it's based on the market value of $2. Fair value of NCI. So I acquire 80%. And the fair value of NCI is 2 million, which is at 20%. My fair value, NCI fair value, so total will be 12, and our fair value at 100%. However, the net asset is only 7.5, therefore the goodwill is 4.5. Belongs to who? Parent and NCI. Goodwill belongs to parent and NCI. Some are parents, some are NCI. Okay. Come, let's prove it to you why parent only and this one NCI. You see here, if I use proportionate method, goodwill is 4. If I use the fair value method for NCI, goodwill is 4.5. Can we tell from here? Parent is 4. Over here, parent and NCI is 4.5. NCI will be 500. NCI 500. Okay, let's prove it here. I rub this off. Okay. I show it this way. Horizontal, vertical. Okay, horizontal. 20%. This is the total. The net asset is 7.5. Subsidiary, correct? I acquire 80%, so this one here owns 80% by me and 20% NCI. So we know that 20% is 1,005 by NCI. Myself will be 6,000. Is it okay? So 75 minus 5, 15 will be 6,000. And how much I pay for this 6,000? How much do I pay for this 6,000 asset? I pay 10,000. I pay 10,000 to acquire 80% of subsidiary, which is worth 6,000 only. So this is how much I actually paid, 10 for 6,000 for 10,000 for an asset that is only 6,000. And how, what is the value of the 20%? We calculate them at how much? Their proportion. So their portion is 1/5. So I'll take that non-controlling interest will be valued at 1/5. So you add up 10,000 plus 1,005 is 11,500, correct? So total goodwill 10 plus 1,500, then 10 plus 1,500 is 11. We took over the assets here is 7,500, so total goodwill is 4. Then total goodwill is 4. Then we look at how much belongs to parent NCI. NCI will be 1,500 minus 1,500, new, nothing belongs to NCI. 10 minus 6, 4. Can you see now the goodwill, everything belongs to NCI, parent? Goodwill, everything belongs to parent. Let's prove it here, 80% and 20%. I pay 10,000. This 7,500. My proportion is 6,000. Their proportion is 1,500. Okay. 80% and 20%. I pay 10,000 to acquire 80% at 6,000. So I'm actually paying my goodwill is 34. What about the NCI? We value them at fair value. So the fair value, their portion is of 10%, fair value is 2,000. That's 2,000. So 10 plus 2 will be 12. 4,005. This goodwill belongs to parent and NCI half. That's 4,000 to parent and 500 to NCI. Okay. Now, how significant is this to determine whether it is parent or NCI together? So, example, the first part here. It is based on the first method, proportionate. My goodwill is 4,000, and the question mentioned there's an impairment of 10%. Impairment of 10% is impairment 400. So, this 400 impairment is an expense. Comes to who? Just parent. No need to share. I own 80% only, right? If there is an impairment of 400, 10% 400, this 400 here will be charged direct to the parent. Okay, you don't share with NCI because all this belongs to parent. However, if the second method here, means based on fair value, if the question says there's an impairment of goodwill of 10%, so impairment will be 450. Right? 450. So if 450, we have to share 80% charge to parent and 20% charge to NCI. Have to check. Okay. Yeah. So remember, for method 1, it will be 10,000. You look at your net asset 7,500. You transfer to the proportionate. Otherwise, we use the fair value. Fair value normally is determined using the share price. Done. Example 1.47. P acquired 75% of ESCO on this date when the retained earning is 15. So this is the pre-acquisition profit, pre. When I buy the subsidiary, their retained earning is already at 15, pre. The market price of S share is 160 and P value their non-controlling interest at fair value at acquisition using method 2. Goodwill is not impaired. And what is my consideration transfer to acquire that 75%? Yeah, I pay 68,000 to acquire 75%, meaning the NCI will be 25%. NCI will be 25. So prepare for goodwill. This one we're going to audit. This one is from your CR2 or the CR1. So goodwill calculation. What's the consideration transfer? 68 is for how many percent? Yeah, I acquire 68. I acquire 75%. I pay 68. So consideration transfer is 68. And what's the value of that 25%? Yeah. We need this. $1 each means I acquire 75%. NCI will be 25% of that 50,000. Correct? 25% of the 50,000, that will be 12,005. And the 12,005 shares, each of them is worth $1.60. 12,005 shares, each of them is 160. So what's the fair value of NCI? $20,000. Fair value of NCI, 20,000. Okay, so put it here, 20,000. And we know the net asset will be ordinary share plus retained earning. This is pre-retained earning, 15 over here. Ordinary share and pre-acquisition profit. Ordinary share plus pre. So this is the fair value of asset at the day of acquisition, 65. Yeah. Goodwill will be 23. Question: this 23,000 goodwill belongs to parent only or parent and NCI? Parent and NCI, because the NCI will be at fair value. NCI is valued at the fair value. Therefore, this goodwill belongs to parent and NCI. Is it okay? So I acquire at the beginning of the year. When the retained earning is 15,000. I acquire at the beginning of the year when the retained earning is 15. What is the retained earning now? Now is 25. When I buy it was 15 only, and now it's 25. How much is my post-acquisition profit? 10. Post-acquisition is 10. Okay. So I own how many percent? 75. So I will take only my 75% of post. 75% of post. Okay. So retained earning, I'll take parent 70,000 and subsidiary post-acquisition profit, my share. Here, my 70,000 parent and subsidiary today is, as per the question, today is 25. Pre-acquisition, you can get it from here, 15. When I buy, it was already 15. So can I say this is post-acquisition profit? Yeah, this is post-acquisition. I'm going to share 75 and 25. Then 75 belongs to the parent. 25 belongs to NCI. Here and here. Split. Where last one will be your NCI because you're working normally you do it at the end because NCI is normally you use the working from working 1 or working 2 or working 3. So NCI is the balancing. Okay, you always take from other working and then it transfer to NCI. So example here, when I buy at the day of acquisition, NCI is already at 20,000. Correct? So this 20,000 will come here. And after the acquisition, NCI owns 25%. That's why they will share 25% of the post end. Put it here. So this is the value of the NCI. Okay. So with working 1, working 2, working 3, we can now prepare the console, a simple console. Parent plus subsidy. Here, I do it here. Parent plus subsidy 110. Share in subsidiary, you think of goodwill. Goodwill you refer to working number 1, 23, correct? Total up 133. Current asset, parent plus subsidy will be 87. You add up 220. Double line, close. What about ordinary share? Ordinary share, very basic. You must get this mark. Take parent only, correct? Huh? Take parent ordinary share, 100,000. Retained earning, look at the working. Retained earning, working number 2 is 77.5. 77.5. 177.5. And do not forget, after your retained earning, your total, you have NCI. How much is the NCI? Working number 3. 22.5. And your liability. Current liability will be parent plus subsidy 220. Yeah, balance. Answer next page. In your exam, do you have to total this 133? In the exam, you can skip the total. In the exam, do you want to total this 220? This is the waste of time, don't total. Do you want to total this? Total, forget it, don't total. Then how to balance? Forget it, it's not about balancing. Okay, you will never balance in exam. Is it okay? Can you accept that you will never balance? If you accept that, it means you go in, you're not there to balance. You are there to grab all this marks with the workings. Okay, you are there to grab all this marks with your working, and then just accept the reality won't balance in exam. Okay, and you are not there to balance. Okay, get your priority right. If you really want to balance, then please don't adjust. Just add a cross, confirm balance. But you will pass. Understand what I mean? So priority is not to balance. Okay. Now, what happened if it's based on proportionate method, working method 1. So over here, the goodwill is based on method 2. If it's based on method 1, what should I do? 68,000. Then what happens to my non-controlling interest? I take 65 times 100%, 25%. Clear? You get this first, means your ordinary share plus your free net, you add up is 65. And we own 75, means the other 25 belongs to NCI. So you take 65 times 25%, you get your NCI. Over here. 68,000. And then once you got 65, ordinary share plus retain, you times with 25, this is the proportionate method. And this one belongs to who? Belongs only to the parent, because this one we use the method 2. Proportionate method 2. Method 1, sorry, method 1. Okay? Okay. This one very basic one, just to recap on it. I mean this is console question. NCI, NCI you take from where? This one over here we take from your working number 1, which is at fair value. So now since that proportional method, so our NCI will be 16,250. Our working 3, we start with 16,250. And then we take our share of post-acquisition profit. Everything will be the same. Okay, conceptually everything same. Just the calculation for goodwill only. Alright, that's it. Let's look at this example. Again, we're going to audit the answer question. Required. Prepare console SFP for the year ended as at 31st October 2010. 2010. You are provided with the following. Investment in Mino is 200,000. Ordinary share of subsidy is 170, and the retained earnings today is 50. So nothing much. Let's look at note 1. Sharp purchase 70% of ordinary share in Mino 4 years ago. 4 years ago. When the retained earning is 20,000. So at the time it was 20,000. So this is a pre-acquisition profit. It's important for my goodwill calculation as well as group retained earning. Working number 1 and retained earning. There has been no impairment of goodwill. Okay. For the purpose of acquisition, plant in Mino with a book value of 50 was revalued to its fair value of 60. The revaluation was not recorded in the accounts of Mino. So depreciation is charged at 20%. So you can see here, there is an asset here, which is at 50, should be fair value should be at 60. So business combination, IFRS 3 fair value, IFRS 3 business combination. When we took over subsidy, it must be valued at fair value. Book shows 50, but console we must show them at fair value. That's why I got all the fair value. So 60,000, and it's not recorded. So what must I do? We have to record. So fair value adjustment plus 10. Sorry, it's at plant, not at fixture. Plant 10. Depreciation is 20%. So this year already depreciate how many times by this year? Because I acquired how many years ago? 4. So 20% will be 2. So for the past 4 years, I should recognize another 2 for 4 years. So the additional depreciation, so I add 10. I must make sure I adjust for the additional depreciation of it. 2. Sharp sell goods to Mino. Sharp is parent. Sharp sell to subsidiary at a markup of 20% at 31st October, means this year. Inventory of Mino include 45,000. 31st October 20x0. Inventory include 45,000 closing. This is your URP. You look at URP is the unrealized profit. Mino O Sharp. Mino is subsidy. O Sharp 35 for group purchase, and Sharp O Mino 15. So we're going to cancel out the inter-co balances. Intercompany balances, cancel. Okay? It is group policy to value the NCI at fair value. So we are looking at working on our method number 2. And the market price of the NCI just before the depreciation is $1.50. Let's compare what's the value of NCI. Yeah. What's the value of NCI? Do you get 76.5? So these are the graphs, these are the marks you have to grab. 76.5. I acquire 70, meaning NCI is 30. 30 of their share, 170. And each share is worth 150. So 76.5. 76,500 NCI. Goodwill. This one you just answer is there, you just see how you just do it together. You don't have to copy. Answer is all there. So we just do it step by step. Working number 1, goodwill calculation. What's the first thing? We put in consideration transferred. How much? Consideration transferred from where you get? From your investment? 200. Then fair value of NCI. Yeah, the working, actually you should do it here. 30% of 170 times $1.50. So that will be 76.5. So you have 276.5. Two 276.5. So we less the what? The fair value of net asset acquired. It will be your ordinary share capital 170 and pre-acquisition profit of 20. And one more is there is no share premium, there is no incentive asset, but we have a fair value adjustment, which is for a piece of plant. Is it subject to depreciation? Yes. So you add a 10 here. 50, it was the fair value was 60, 10. So by right, what you should do is when you have a fair value of 10 here, you should add 10 here, then you go and adjust here 10, so that you won't miss out. So later when you console, you take parent plus subsidy, you have a fair value adjustment here 10. Okay. When you have a plant subject to depreciation, immediately calculate for the additional depreciation. So depreciation is 20% of the 10. Depreciation is 10% of 10 is 2. How many years? 4 years. You times 4, so 8. Immediately you plus and you minus here. Is it okay? Plus and minus the additional depreciation. Where else should I adjust for the additional depreciation? This is the additional depreciation charge for group console. Means it's going to affect group profit. Should I adjust in parent or subsidy? Parent or subsidy? Very important to determine parent subsidy, because if it's parent, no issue with NCI. If we're going to adjust subsidy profit, means we're going to affect NCI. We have to share the NCI because we own 75%. So are we going to adjust the 8 in parent or subsidy? Answer, subsidy. This one is subsidiary asset. When we console, when we took over, their asset should have been higher. Means their depreciation should have been higher. So their profit, therefore, we have to adjust for 8. So subsidy profit needs to adjust by 8. So subsidy profit needs to be adjusted by 8. You can see in the working 2. Can you see here? Adjust in minor subsidy. Retained earning working, we must take our portion, which is 215 plus subsidiaries post-acquisition profit. So post-acquisition profit now is 50. Here, mine is 215, subsidy now is 50. But acquired 4 years ago, it was only how much? Where is it? It was only 20. Now 50. It was only 20 previously. So what's the post-acquisition? 30. However, we have to adjust for the 8 additional depreciation. That is why you see here. 50 minus 20, I should have 30%. But I have to adjust the additional depreciation throughout the 4 years. Okay? What about the goodwill? Goodwill, you add up here will be 200. And this one will be 76.5. And if by right, once you stop here, the next thing you don't know underline. The next thing is you go and look for the notes to see if there is any impairment or not. First of all, this one belongs to parent or subsidy, belongs to parent only or parent and NCI. Both. So parent plus NCI. So in case there is any note on impairment in which we have to reduce, the reduction, the cost must be shared by. But there's a note stated there is no impairment, right? So we can draw a line and that's it. Okay, so working one setup is there. Here, 76.5. Next thing, note C. Note C. Yeah, by right, this minus 8 here, you can actually put a note here as minus subsidiary 8. Subsidiaries profit. Minus 8 credit and you debit here 8. So you will forget lah. Minus 8, minus 8. Subsidiaries profit. Note C. Shark sell goods to Mino at a markup of 25%. Markup is on cost of profit. 25% on cost. At 31st, the inventory of Mino was 45,000 for goods purchased. So still got 45,000 remain unsold, meaning there are still some portion which remain unrealized. So calculate URP. URP, unrealized profit. Still remember? Or you want to go back to basic again? Teasing you, I go back to basic again. Jose, can you get URP? Alice, yes? Isaac, URP? Unrealized profit. You should get 9,000. 9,000. Gideon. Can you get 9,000? So, okay, answer is 9,000. We look at the concept first. If parent sell to subsidy, it's important to know whether is it parent sell to subsidy or subsidy sell to parent. Calculation is the same, adjustment will be different. Okay, parent sell to subsidy. Who is the seller? Parent is the seller. Who make the profit? Parent. So subsidiary purchase. So the seller make the profit. So I use my example. Let's say parent sell to subsidy 120 when the cost is 100. So actually parent make $20, correct? Buy 100, sell 120. So parent individual account. Individual account. I told you before. In a group account? Group, yes. So 20. If subsidiary left half, means there is still $10 is remain in the group, correct? So we have to adjust for the 10. So adjust in parent or adjust in subsidy. So the URP is 10. So we have to adjust in parent or subsidy, both parent retained earning and subsidiaries inventory. Clear? So the fact that we adjust in parents retained earning means it won't affect NCI. Clear? What happens if it's subsidiary sell to parent? The seller make the profit. So if there is an unrealized profit of 10 using the same example, so retained earning, adjust in subsidy, and adjust in parent inventory. And the fact that we adjust subsidiary profit is going to affect the NCI. So this question, who sell to who? Parent sell to subsidy. And they remain 45,000 inventory. 45,000 remain in subsidiaries inventory. Markup at 25%. So this is how many percent? When parent sell to subsidy. Okay, this is the sales. So is this 125%? So you divide by 125. You times with 25. 45,000 is 125%. So you divide by 125 times 25, you have a 9,000. Okay. Today's class until 3:30. Yeah, because last week you say you want to cut short 1 hour. Replace this week? Huh? You didn't, yeah, but others they have. Okay? And remember, you always come in half an hour later, so you need to replace. Fair. Okay, adjust 9. Where? Parents sell to subsidy, adjust in parents' profit, 9. Here, sorry, 9. Adjust in inventory, 9. Eliminate. Okay? Next. Minnow O to S, Minnow O to shark, 35. Minnow O shark, 35. So it must be in their liability, 35. It must be in their receivable, 35. Cancel off. I owe you, you owe me between parents, I need to cancel off. Okay, in your exam, is it important that you minus from the subsidiary 35 and then here from the parent? Or can I just put here as minus 35, 35 as a note to minus from payable and receivable? Can. Doesn't matter is it parent or subsidiary, because answer will still be the same. But when you practice, in practice, when you work, it's important. Okay, now you must know whether you cancel off subsidiary or cancel off parent. So in this case here, we debit payable. Correct not? Debit payable is the reverse out. We credit receivable in parent. Debit payable subsidiary. Credit receivable parent. You must do it clearly, show it clearly. But for exam, you just minus 35, 35, that's it. Then, what about this? Shark O minnow 15. Shark O to minnow. Shark O 15. So minus from here 15. Minus from parent 15. Subsidy 15. Okay. So can you see now? Parent retained earning, I adjust 9. Subsidiary, I need to adjust for the additional utilization. Additional utilization, and this is your URP. Unrealized profit. Put it here. Additional utilization under parent URP. 22 share. 70% come here. And 30% go to NCI. NCI, you take this figure, 76.5, you plus 30% of 22, because 70% come here. 30% will come here. Okay? This one, NCI. NCI, always you do it later. So NCI you get from your working. Working number 1, NCI. Here, at the date of acquisition, the fair value NCI is 76. So after I took over, NCI had 30% of the post-tax. So this is the post-tax, 70% go to the group, 30% go to NCI. Okay, all right. Done. Actually, you don't have to do number 5, number 6, number 7 because everything will be done in the working here. Any question? No one? Everything still at basic level. So we take a break. Not continue. Compute goodwill on consolidation for Conoco. There will need to be included in the console. Sure. This one we focus only on the fair value. How to determine the fair value? Alright. Taizo prepared accounts on the 1st. And on the 1st of September, Taizo acquired 6 million shares at $2 each. So at the date, Kono produced the following interim financial. Taizo acquired Kono. So this is Kono's financial statement. PPE 16, note 1. Inventory, note 2. We look at note 1. The following information relates to PPE of Kono on 1st of September at the date of acquisition. Gross replacement cost, net replacement cost, economic value, and RV. So carrying value is 16. When we took over subsidy, carrying value 16. We must measure them at fair value. So which one is the fair value? Gross replacement, net replacement, economic value, NRV. You know NRV is applicable to which one? Net realizable. Your inventory, the lower cost, and NRV is the estimated selling price, less further processing cost, less any cost necessary to make the sale. So we have gross replacement, we have net replacement. So what's the difference between these two? I gave you an example before last time, remember? Net replacement cost, somewhere, forgot. I'll give you this example, probably you can remember. I buy an asset 2 years ago. It cost me 1,000. Depreciated 2 years. Let's say 100 and 100, so it will be 200. This is my carrying value or net book value. This particular asset, when I bought 2 years ago, was 1,000. Today, 2 years later, I want to know the fair value of this asset. So if I were to buy from the market now, it will be 1,002. So what is the fair value? If I were to buy now, I have to replace my asset replacement cost. I have to buy 1,002. So what is my fair value of this asset? Not 1,002, because this one here, my book shows 8. If I were to replace now, the market value buy now and new, it will be 1,002. I have to depreciate 2 years, 120, 120, 240. So it will be 960. So this is my fair value. We call this the net replacement cost. This is the gross replacement cost. This is the net replacement cost. So for asset, the fair value, we take the net replacement cost, which is 16.6. I've explained this before, right? Somewhere. Yeah. Net replacement. Therefore, when I buy the asset at 60 carrying value, but the fair value is 16.6. So we should therefore have a fair value adjustment of 0.6. Fair value adjustment is 0.6. We use 16. Carrying value is 16. 0.6 is the fair value adjustment. Next, the property, plant and equipment of Kono on the first had a total purchase price of 27. Total purchase price, this is the original cost. Let me explain here. Yeah. 27 million total purchase cost. They were all depreciated at 25% on a pro rata basis. This policy is also appropriate for console purpose. No non-current assets which were included in the interim were disposed of, means whatever that appeared here is not disposed of at the end. Okay, they were depreciated at 25%. Total cost is 27. I have already depreciated how much? About 11. That's why I left it. And none of them were disposed of. No non-current asset was fully depreciated at the end. So that's why we can use this net replacement cost. Okay, this is our fair value. We never use gross replacement. We don't use net realizable value because that is more applicable to our inventory. And economic value is not included. So net replacement cost. So our fair value will be 0.6. Number B, the inventory of Kono subsea, which were shown in the interim statement, are raw mat that cost. It costs 4 million. So here we have a 4 million cost. They would have cost 4.2. They would have cost 4.2 to replace at 1st of September. Of the inventory in hand on the 1st of September, goods costing 3 million were sold for 316. You can sell above cost. So there's no impairment in this case. So between 1st of September and 31st. So what happened is, on the 1st of September, when I acquire the subsidiary, the inventory has got a value of 4, which is that cost. And they have a replacement cost of 4.2. So now I have to adjust for fair value for console purpose. For console purpose, should I take the original cost or should I take the fair value? Consolidation must always take a fair value. So the fair value is 4.2. Therefore, what is the fair value adjustment? 0.2. So we have to add another 0.2 to make it 4.2 for consolidation. So we have two fair value adjustments. One is additional 0.6 and additional 0.2. On this date, on the date of acquisition, Taizo took decision to rationalize the group, restructure the group, so as to incorporate subsidiaries. Okay, probably they downsize or expand the business to integrate the business. And the cost of rationalization were estimated to be 3. Estimated to be 3 means haven't incurred yet. To rationalize, okay, the whole group will cost 3 million, and the process was due to start only next year. And no provision of this cost has been made in any of the financial statement given above. So the question is, should we provide? Should we provide? Since I took over and I'm going to incur 3 million to rationalize. So should we take this into consideration? If question yes or no. If yes, should we record them as part of our bookkeep adjustment? Yes. So answer is no. So yeah, if you say yes, means yes, we're going to recognize this 3 million as our liability, and liability should be taken into consideration as part of our goodwill calculation. So since the answer is no, means no, we're not going to take into consideration enough. We're not going to record this 3 million. Hence, we're not going to adjust our goodwill. Provision account. So if we recognize future costs, rationalization has got nothing to do with our consolidation concept. Okay, whether you want to rationalize or not is up to you. So it's not an obligation. There is no obligation. You know, today I decide to rationalize after October. Can I decide not to rationalize? Okay. Okay? So there's no obligation to actually incur this 15 million. So no adjustment or no recognition to be made on this liability. So how much I'm going to pay? I'm going to pay 2 million, $2 per share to acquire 6 million. So my consideration will be 12 million, right? I acquire 6 million means 75%. Means the other 25% is NCI. Agreed? I acquire 6 million of 8 million. Means I acquire 75%. 25% is NCI. So let's calculate goodwill. Goodwill. D, not D. It is group policy to value the NCI and its proportionate share. Method 1. Proportionate share. So I buy 6 million at $2, this consideration transfer. How to get the fair value of the asset? Yeah. $8 million. And this is the reserve on 1st September. So this is my pre-act. I got two fair value adjustment. One is 0.6, one is 0.2. Fair value adjustment 0.6, 0.2. So when it comes to goodwill, yeah, ordinary share, pre-act, and the two fair value adjustment. Therefore, this is my fair value of net asset acquired. Goodwill, therefore, will be 2.1. Belong to parent or parent and NCI. Only parent, because this is proportionate. You take 13.2, transfer here, 25% is proportionate method. Proportionate method. Can we calculate using fair value method? NCI, how? 12 million. What is the fair value of my NCI? One share is $2. 2 million shares is 4 million. Can you get? This one is proportionate method. This one is fair value method. 12 million will be the same. How to calculate the fair value NCI? $8 million. 2 million belongs to NCI. How much is per share? $2. So 2 million times $2, it will be 4 million. Total up 16. Total up 13.2. Therefore, my goodwill is 2.8. Belongs to both parent and NCI. Yeah. Done. Okay. Done. Move on. Okay, 3.6 exam won't be tested when this initial counting is complete. Adjustment after the initial counting is complete. So exam not important, but I'm still going to explain for you. Okay. Now, within 12 months of acquisition or from the day of acquisition, apply them back to the meaning I have already calculated my goodwill here. I have already calculated my goodwill, but the fair value adjustment of the PPE is not yet completed because it's subject to the estimation by the professional valuer. I repeat, because we have to adjust our fair value for our PPE. So at the moment now, I will need to close my accounts. So when I need to close my accounts, I need to prepare my goodwill. So the fair value I still can't determine with 100% sure because the professional valuer are still estimating it. So the report will only be released very soon. But I have to close my account already. So I need to record my goodwill. So if the report is out and is within 12 months of the acquisition, do I go back and adjust my goodwill within the measurement period? If it's within 12 months, yes, I have to go back and adjust my goodwill. If I have already calculated my fair value here, 0.6. Later, with the report is out, after the report is out, if it says 0.7 or 0.8, I must adjust my goodwill. Within 12 months, I have to adjust within the measurement period. Okay, not? If the report out after 12 months, means we have to adjust them in our revaluation reserve. It's part of our revaluation reserve. Is it okay? So we go through here. Some fair value of the acquiree of the subsidiary. We are the acquirer, we have the acquiree. So sometimes fair value of subsidiaries identified asset can only be measured provisionally. Means not 100% confirmed, provision only. By the end of the period in which the combination actually has taken place. So in this situation, we, the acquirer, should account for the combination using the provisional value because we don't know the actual value. So the acquirer should recognize any adjustment to those value. If it's within 12 months, by within 12 months we know the actual value, we must go and adjust. Is it okay? And it has to be applied retrospectively. So once we adjust the fair value, means the goodwill should also be adjusted. Correct? We've done this before for our deferred tax. So when we adjust for deferred tax, asset or liability, adjust the goodwill. So that's it. Not coming out like that. Yeah, not coming out. Alright. Subsidiary done. Hopefully you still remember associate. If no, then we just quickly go through associate. What's the keyword for associate? Significant influence. How many percent when you have a significant influence? How many percent? Is it more than 50? More than 50 is control. Control is subsidiary. Less than 50 and more than 20. Normally, the standard did not mention how many percent. But we know it has to be more than, it is normally more than 20, but less than 50. Is it okay? Significant influence. Page 16. Page 16. Example. P code, a company with subsidiary acquired 25,000 of the 100,000 ordinary share in A. How many percent? 25%. So, do I have a significant influence? Yes. Of course, question must mention, is there any significant influence? But 25 more than 30% indicate as yes, we have a significant influence. I bought it for 60,000. So, this is my cost of investment. In the year to 31st December, means 1 year later, A earned a profit after tax. Underline after tax, it must be after tax. 24. So associate make 24,000 profit after tax, from which he declared 6,000. So do I get a 25% share of the 6,000? Yes. So I'm going to get 1,005 from the 6,000 that they declared. I'm going to get 1,005 dividend. How will ACO results be accounted for in the individual as well as in the consolidated accounts? If it's an individual means separate account, my investment will be 60,000, and the amount of 1,005 that I'm going to receive will be this entry: debit cash or debit bank, and I credit income. Understand? Debit bank, credit income in a separate account. It's just any income from anybody. Debit bank, credit income. Yeah. Individual setup. Consolidation, we have to use equity method. Equity accounting method. We don't call it consolidation, we call it equity accounting method for associate. How? For consolidated account, the entry will be debit bank, debit investment associate, credit income from associates. So how do you come about this amount? I'll show it here. How much is my cost of investment? $60,000. If associate make money, will my investment value go up? Yeah. If my cost of investment is 60, associate make profit of 24,000. Should I be happy? Yes. Now, if they make 24,000, my investment is 6,000. If they declare zero dividend, what happened to the value of my investment? I invest 6,000. We are looking at the concept. I invest 6,000. Associate make profit 24,000 after tax. So this 24,000 after tax belongs to who? Belongs to the company, which I'm one of the owners, correct? So I own how many percent? I own 35%. So when associate make money, actually I should be happy. If they don't declare dividend, should I be sad? No. Why? Because if they don't declare dividend, their 24,000 will remain in the company, means their net asset will increase. When their net asset increase, means my value of my investment will also increase. Agree or not? If let's say associates make money, they don't declare dividend, means the money is all kept in the company. So if I own the company and the company size has increased, means the value of my share will also increase. Fair. So you don't declare dividend, I have no problem. As in the value of my share will price and so on. What happens if that money they declare to be dividend, the whole thing? Once they declare, the value of the company will drop. What happened to the value of my share? Drop. Should I be sad? No. Why? Because when they declare dividend, and when the value of my share drops, they declare dividend, I'll get the dividend. So the value of my asset drops investment, but at the same time, I receive the cash. Can you see? So the question now is, okay, whether they declare, they don't declare dividend here, I will be happy if they make money. Agree? They make money, I will be happy. Means either my investment will go up, if they don't declare. If they declare dividend, my investment value go down, but I will receive the cash. So as long as they make money, I will be happy. So in this case, they make 24. They make 24. So I got how many percent of the 24? 24,000, and I have a 25% share, that will be 6. So the value of my investment using equity method will be the share of associate profit. Six. The value of my investment will go up by 6. 24, I have a 6,000 share. Okay? And then, remember they declare dividend of 6,000 here. They declare a dividend of 6,000, of which I actually received 1,500. So when they declare dividend, the size of the company will go down. Means my investment, the value will also go down. Correct? So the investment will go down by 1,500. 64,500. Up by 6, down by 1,500. Can you see my investment drop by 1,500? Yes, but should I be sad? No, because even though my investment dropped by 1,500, can you see when I receive the dividend, I record in my book individually, I have an asset here of another 1,500. So investment asset down by 1,500, but my cash will up by 1,500. So knock off. So overall, my asset will go up by how much? 6,000. Overall, my asset will go up by 1,500 plus 4,500. So overall, up by 6,000 asset. Exactly. That's exactly my portion of 35% of the 2,000, 35% of the 24,000. As long as they make profit after tax, I'm going to recognize it in my asset. Okay, either in my investment or in my cash. It depends whether you declare dividend or not. Clear? So that's why you can see from here, debit investment in associate from 60,000, I debit 4,500, so it becomes 64. Okay. For consolidation purpose, the pro forma means the example of consolidated. First question is, should I console my associate? Do I console my associate? No. We only console with our company. So the pro forma for SCL, everything will remain the same, except that we have a share of profit and it has to be after tax. That's why I told you to underline after tax. So where do you put in the share of profit from associate? Just before the tax. Profit before tax. After tax, before tax. We don't console SPL, sales, cost, profit, nothing. We only take into consideration our share of profit of associate. And our share must be associate after tax. Where do we put it? We put it just before the profit before tax. Just above. Can I? Now, upstream, downstream. Before that, we have a console SFP. Already mentioned to you just now. We have to have include the cost 6,000. I mean, up there like this, we produce it here, and share of associate profit. So my investment will go up by 4,500. So this is my SFP. What happens if I make a loss? Share of associate profit will be reduced or become a negative. This my investment becomes lesser. Associate make losses, my investment will drop. Hope you still remember SPL, SFP. SPL, share of profit here. SFP, we only have this thing. Cost, we have to adjust for the share of associated profit. We call this equity method. Next thing you need to know will be upstream and downstream transaction. It's just a term, but it's actually parent sell to associate, associate sell to parent. This way, if parent sell to associate goods, we call this downstream. If associate sell goods to parent, we call this upstream. Earlier we learned unrealized profit, P sell to S, parent sell to subsidy, subsidy sell to parent. This one is parent sell to associate, associate sell to parent. Downstream, upstream. Be careful with associate. URP, we calculate as usual. URP, we calculate, is either markup or is it margin? The leftover inventory, we calculate the URP. But for associate, if I own 25%, so I have to calculate URP. I times with whatever, let's say 100 times divide 125 times 25. If I own 20, normally calculate URP this way, right? Example, 100 divide 125 times 25, that's it. If this is an associate and I own 30%, you just have to add in another 30%. Must. Everything remain the same, except that you have to add in your portion. Parent sell to associate, associate sell to parent, URP calculate similarly, just like your parent. The only difference is you have to add in your percentage of ownership. Okay. So when you look at here, when you revise, PUP is provision for unrealized profit, always times your percentage, 30%. Example, provision for unrealized profit times your associate ownership, 30%. Example, 30%. So that's why you add another 8% then. We look at 4.7. A code, a parent with subsidy hold 25% of equity share in B code. A makes sales of 1 million to B at a cost plus 25% markup. Markup at 25%, and at the end, B still has all, everything of this good still in hand. Is this upstream or downstream? A hold 25 and A make a sales to B. A sell to B. So this is parent, this is associate. So it's a downstream. So let's calculate what's the URP first, then we look at the adjustment. URP will be unrealized profit. 1 million. Everything remain, so 25% markup. This 1 million is how many percent? I sell 1 million, so 1 million is the sales. Markup means 25% on cost. Cost will be 100%, therefore sales is 125. Markup is on cost 100%. So my sales will be plus the profit. So sales is 125, means I divide by 125 to get 1%. I times with 25, right? Markup 25. How much is the URP? Huh? 20,000. 20,000. 200,000. So the URP is 200,000, and normally we stop here, right? But because this is associate, we have to times our portion. What is our ownership? So the 25 will come here. Add one more, this one. Ownership. So that will be, excuse me. Okay. All right. Who is the seller? Parent is the seller. So parent will make the money, profit. So we have to eliminate this 50,000. So we should debit retained earning, pick up from the parent. So debit retained earning of A. Debit retained earning of A. And normally what we credit, we have to credit inventory of B, correct? But do we console subsidiaries inventory? No, associates inventory? Parent and associate inventory, I got 100 and I got 50. Do I console the 50 here? We don't console means we cannot adjust subsidiary or associate inventory. Therefore, we debit our retained earning. We credit investment in the associate. Credit our asset here, investment. Repeat. Normally, A sell B, we minus from A's profit, and we minus from B inventory. But because associate, we don't console associate inventory, so we cannot minus from associate inventory. We cannot minus from associate asset. So where do we minus? We minus from our investment asset. Cancel off our investment means our profit will be lower. Means our investment lower. Okay? Associates profit, our profit will be lower. Therefore, our investment share, our value will be lower. So we minus up from our associates. Investment in associates. Not inventory. Yeah? Now, here. If the sale has been from associate B to A, upstream, still debit retained earning, reduce our profit, and where do I credit? Because I'm having the inventory in my group, so I'm going to credit out from my inventory associate. Is it okay? Repeat. Downstream. Okay, because I sell to them, I make money. But however, associate still hold some of the inventory, means some of it still unrealized. So means some of the profit unrealized I have to pick up from my profit. So I'm going to pick up from my profit, and I can't pick up from the inventory. So I'm going to reduce it from my associate investment in associate assets. But here, when we sell to A, I own 35% of this associate, correct? When we make money, I have 25%. So when they make money, I have 25%. So I have already recognized it in my book. So I must take out from my book the 25%, debit retain earning, and when do I credit? Because I have the inventory unit which is higher. So I have to eliminate the URP from my inventory. So you notice one thing here, I definitely going to debit retain earning, reduce my unrealized profit. But where do I reduce? It depends whether it is upstream or downstream, but definitely I'm going to reduce the asset. Investment in associate or inventory assets. Reduce profit, reduce asset. Okay. So let's try this. I create this now. Let's say P sold goods to A for 24,000 at 20% margin. 40% of the goods remain in A. P own A 30%. So what is my URP and what is my adjustment? Five 576. Margin is on sales. Margin means profit on sales. Sales is my 100% base. So now I know 2004 is 100%. So URP 2004, which is 100%, so we divide by 100%, and I times with the profit, alright? So the profit will be 480. You can see from here is 480. So out of 24. So 4,008. Unrealized profit, no, the profit is 4,008. However, 40% remain means 40% will be unsold. So this will be my unrealized profit. But because it's associate, we're going to times it 30%. Otherwise, we stop here normally, right, for subsidy. So 4,008 times 4 will be 1920 times 30%, 57,576. Double entry, debit, credit. Debit, retain earning, always debit retain earning, and be careful here with credit asset. Which asset? Investment or inventory? We sell to associate. We do not minus the inventory because we don't console. Therefore, we must minus the investment in associate. Reduce our investment. 576. 576. Okay. Right. Example 20, page 20. Page 20. So this is an example of associate, subsidy associate. Again, it's just a basic only for subsidy and associate. Yeah, by right. This is just a basic only. So this one I do this because for it to be can important, very very important. Subsidiary and associate. Go back everybody. Dig out your FR1 to CR1. Throw it in. So many years ago. You see, once you complete your example ACCA, once you have completed your ACCA, you can actually throw away your marketing book, you can throw your accounting, your business analysis, Mr. Alex, throw. You can throw. You can throw your people financial management, yeah, you can throw. But the only one that you cannot throw is this one. You cannot, because if you go to audit, work in audit firm, or you work in if you are in accounts, you need to do consolidation, you will definitely need your notes. Okay, last time when we work as auditor, so after 1 year, 2 years, our old notes, everything becomes outdated. So we ask all those juniors, hey, you just graduated, right? Please bring all your notes here. We want to refer. Cannot only console, your standards as well as consolidation. Standards, no need to, standards is okay because normally in the company, last time hard copy, no soft copy. Hard copy, your boss will have one stack, IS 1, 2, 3, 4, all the way, everything is there. Okay, but now you can access to the internet, so no issue. Okay? So don't throw. Odd way. Ready? Odd way, a public limited company acquired a subsidiary, Hogarth on 1st July 2002. And an associate better be on 1st July 2005. We are now in 2006. June. So subsidiary, no, associate we acquire at the beginning of the financial year. Subsidiary many years back. Investee means these are my subsidy, this is my subsidy, and this is my associate. Ordinary share capital 4, share premium, retained earning, and also this one is our revaluation reserve, fair value of net asset. The detail of the acquisition at the respective date. Can I say that this is at the date of acquisition? The detail of the acquisition at their respective date means I buy a different date and this is their balance, okay, at the date of acquisition. So it's important for our goodwill calculation. Ordinary share is capital. Share premium is reserves. Reserves retained earning is reserve. Revaluation is reserves. And what we have here is the fair value of net asset at acquisition. So C plus R, what do I get? Capital plus all the three reserves, CR. Okay. Capital plus reserve is my equity. So can we add, how much is my equity? $700 and 552. Cost of investment is 765. Hello. Okay. Cost of investment 765 and ordinary share capital. Can you cancel off this one? Actually, is the number of shares 320. I acquired 320 shares. How many percent I own? Is it 80%? 320, you compare to, yeah, you odd way. You buy Honda 320. And here you have 400, 80%. What about associate? 25. Okay, so for SFP, I draw a line here. Why? Because we're not going to console associate in case you accidentally go and add on. So we're never going to add letter B because it's just an associate. Okay. Now, you look at here, what happened? The equity is 700. Fair value is 800. So is there a fair value adjustment here? Equity is 4 plus 1, 4 plus 1, 2 plus 40 is 700. However, the fair value is 800. So there's a fair value adjustment of 100. Is it okay? So we look at the notes. Oh yeah, SPL right at the bottom. I draw a line here. I'm not going to console. But which amount is important to me? Associate. Profit after tax. Just now remember the 24,000 is profit after tax. So we need profit after tax of 148, and we're going to share this. 148 plus 8. We're going to share 148, we're going to share 8. Clear? Note A. Neither Hogarth or Batterby has any reserves other than retained earning and share premium at the date of acquisition. Neither has issued any new shares since acquisition. So no issue. The fair value difference on the subsidy is related to a PPE being depreciated through cost of sales over the remaining life of 10 years. The difference is because of the PPE with a 10 years useful life. The fair value difference on the associate related to a piece of which has not been sold since the acquisition. Not so important for the associate, but it's more important for us, for subsidiary. Meaning the fair value difference of subsidiary. Which one are we talking about? There. 700 is the carrying value. However, the fair value is 800. And they tell us the fair value difference, in this case 100, is due to a PPE, in which we have a 10 years useful life. Must we adjust for the $100? Must we adjust for additional depreciation? Yes. How many years? No, you see, I bought in 2002. We are now in 2006. So 3, 4, 5, 6. 4 years. I have to adjust for additional depreciation 4 years. 3, 4, 5, 6. Why? Additional depreciation will be 100 divided by 10, and all in all will be 4. So 40. Additional depreciation will be 40. This year alone is 10. Okay? And remember, what should you do here in the PPE? What must you do here? Plus. How much? Then remember to minus 40. Do we adjust in parent or subsidiary retained earning for the additional depreciation? Parent, subsidiary. Subsidiary, when I took over, their fair value is extra by 100. So additional depreciation of 40 must therefore be turned to subsidiary. So minus 40, minus 40 here. Clear? This year is 10. Over the 4 years is 40. Okay. Can you add in here? Because we are asked to prepare SPL, we have additional depreciation this year charge of how much? 10. Okay, not? Hello, this side. Okay. Okay, very noisy. Very disturbing. Okay, additional depreciation for this year, 1 year alone is 10. That should be included in my cost of sales. So, what do? plus another 10 in subsidiaries account. Okay. Additional depreciation for this year was to be included in the cost of sales, so it's plus 10. All in all, 40. This year alone, 10. Continue. Group policy is to measure NCI at acquisition at fair value, method 2. One is proportionate, one is at fair value. The fair value of NCI given will be 188. No need to calculate, given. Hogarth's intangible asset include 87. Who is Hogarth? Hogarth intangible asset at the moment now we can see is 350. So the 350 include 87 of training and marketing expenditure incurred during the year 2006. So we are now in 2006. That 350 include this 87 training and marketing. And the director of Hogarth believed that this should be capitalized as they relate to the startup period of a new business venture in Scotland and intend to amortize the balance over the 5 years from 1st July onward. So going to amortize next day, next year. So training and marketing costs. Marketing, training, these are all selling costs. Can we include as part of our intangible asset? IS 38. Research and development. What do I do with research costs? Expense out. What do I do with development costs? Sure. 5. So your answer should be development should be expense of unless you meet the 6 criteria. Okay, or you can put it in, it should be capitalized. Okay, if they meet the 6 criteria, otherwise it is to be expense of. So you can't say it's capitalized or expense of, it depends. So if you meet the 6 criteria, pirate, you're going to capitalize. So question, when I incur material costs, when I incur labor costs, I incur some overhead for development, I can capitalize. Can I capitalize training and marketing costs? No, it has to be expense of. Cannot, if you meet the 6 criteria, you capitalize. Marketing, training costs has to be expense of. So we only capitalize the 300 for development. Training, marketing should be expense of. But what happened? This company here, 87 million, they have capitalized. So what must we do? We have to expense it off. So we have to minus 87. We have to minus 87 from here, and we have to charge to their retained earnings. Okay, now minus asset minus their profit. And intangible asset, whether it's impairment or amount written off, I repeat, goodwill impairment, okay, or intangible asset which is written off, intangible asset, if question is silence, we put it in admin. If the question tells us to put in cost of sales, we add our cost. However, they did not say anything here, did they? No, they didn't mention anything. So we're going to write off into administrative cost plus another 87 here. Cost will increase. Therefore, retain earning drop. Cost increase, retain earning drop. Then cost increase, profit drops. When profit drops, means the retain earning will drop. Okay. Next. During the year, Hogarth sold goods to subsidy sold to parent. Subsidiary sell to parent 1300, and the company make a profit of 30% on selling price means margin. And 140 of these goods were held by Otway. At year end, there's another 60 million at the beginning of year end, beginning of the year. Is this the first time you see adjustment for opening? Normally we adjust URP closing, remaining balance, correct? So what do? We minus from our inventory, right? When it comes to opening, we plus the unrealized profit. Is it okay? So let's calculate URP for opening and URP for closing. URP for closing first. 140 of these goods were held by Otway. 140. Times. This is 30% on selling price. This is margin. Margin sales 100%. So we divide by 100%. Times 30. So what's the unrealized? 42. Let's look at the URP for opening. URP for opening 18. So our net amount will be 24. We're going to adjust 24. This is closing. This is opening. Unrealized profit closing. Our question so far has always been closing, correct? So we adjust only 42, correct? Because the parent subsidiary sell to parent, we adjust in subsidiaries retain, we adjust in parent inventory. But now we also have opening URP, so we adjust the net. So we adjust 24. Adjust where? Subsidiary sell to parent. Some subsidiary sell to parent. So who make the money? Profit. Subsidy. So we adjust in subsidy profit. And parents inventory 24. For your profit. We look at the profit first here. Back to your concept. For P&L, that's a P data. When subsidiary sell to parent or parent sell to subsidiary, in this case is 1300. So what the adjustment in our control? Minus tax. Minus sales, minus cost, and plus cost. Roughly. Minus and we plus. How? Forgot. Like this. If parent and subsidy, sales, cost, okay lah, whatever. Okay. When a parent sell to subsidy 100 and there's an unrealized profit of let's say 30. So parent sell to subsidy 100 the adjustment is minus 100, and we plus the unrealized profit. Correct? Because parents have to subsidy 100, the sales have been included in here. When subsidiary buy from parent, so the $100 must have been included inside here, the cost of sales. So for consolidation purpose, we have to minus out 100 from the parent sales, minus out from the subsidiary's cost. So that's why minus 100, minus 100. Okay, and we have to add back the URP. Why? Because URP means we have to minus out the profit, correct? So when I add the cost, what happened to my profit? Down. Yeah, I eliminate the unrealized profit. Okay, minus sales, minus cost, I have to eliminate unrealized profit. So to eliminate, I add the cost. When cost up, profit down. Yeah, unrealized profit eliminated. Go back and dig up. Minus, and plus. So, what is the sales here? The sales is 1300. Minus sales, minus cost, and we plus the unrealized profit for this year, 24. So you look at the working here. Minus 13, and we plus the URP. Minus, and we plus. Adjustment. Clear? Then what do you do with your URP in your SFP? My closing URP is 42. So I have to adjust the closing balance in my SFP 42. So can you see here? Adjust 42 here. Only the closing balance. Because at the closing date, I still have URP of 42. I must minus up 42 from my inventory. And whose profit should I minus from? Parent or subsidy? Subsidy. So let's do it here. Meaning I have to minus 42 here in the parent, and I have to minus 42 here for the unrealized profit. Is it okay? Cannot. Is it okay? No. Okay. Forget about opening. Closing subsidiary sell to parent, right? Unrealized profit is 42. What do you do? Minus. So you minus from the retained earnings because subsidiary sell to parent, subsidiary make the money, profit. So minus from subsidiary's profit. And who has got the inventory? Parent. So you minus from parent's inventory. So basic. So when you involve opening, then you adjust it here. Minus 1003. This one, the one lah. So I minus 1003, and I adjust the unrealized profit, including opening and closing, because our cost of sales got opening and closing. So I adjust 28. But when come to year end, I only adjust the closing unrealized profit, which is 42. Clear? Twenty-four. 24. minus plus. 24. Any question? Continue or break? Break because this one will take us another 20, 30 minutes.